Hey guys, Tom here from the Investing with Tom YouTube channel. Welcome back to the channel. If you enjoyed today's video, hit like, hit subscribe, and that way you can see future videos as well. So you don't have to search particularly far on YouTube or in financial news to see titles like the stock market is broken or value investing is dead. And I actually recently came across an article or a paper that basically went through and actually statistically showed that a lot of value investing strategies haven't been working. We know for a long period of time now, that probably over the past decade or so, that sort of statistical value investing methods haven't been performing all that well. If you're buying companies simply on a low price to book or a low price to earnings or a low price to sales, it actually hasn't been that successful of a strategy over the past few years, even though over the very long-term data it's worked extremely well. And my perspective on that has always been, well, you know, there's many different types of value investing. There is the people that buy statistically cheap companies on these simple metrics, and then there's people more like me and more like Warren Buffett or Charlie Munger that more look at the future cash flows of a business and take more of a discounted cash flow style approach, and are really more factoring in the growth that a business has and all that sort of thing as well. Well, to my surprise, I actually came across a paper just over the last few days that actually showed that even that strategy hasn't been working over the last 1 or 2 years, and it also actually didn't work during the dot-com bubble. So I want to talk through some kind of fundamentals of what the stock market should be, in theory, behaving like, and how it should respond to companies' earnings and so on. And then I want to take you through some of the learnings I picked up from that paper. So sit back, relax, and let's get into it. So you should see timestamps right along the bottom if you want to jump forward to the results of the AQR paper, which I referred to earlier, and I'm going to talk about in a bit more detail later. But firstly, I want to get back to what drives stock market growth in general. So, you know, we have this long 100+ year history, even longer, of, you know, really nice stock market growth. It's not really linear, it fluctuates a lot, but if we average it out, probably somewhere between 8 to 10% per year returns from the stock market. So I want to talk about what actually drives that in the first place, and that will kind of be related back to maybe why we've seen some weird stuff more recently. So basically, there are two main factors that drive long-term stock market growth. The first one is the businesses in the stock market earn more money and become more valuable. It's pretty simple. We've got this collection of companies that we call the stock market. We can buy and sell ownership in those businesses. And if those businesses grow and earn more money over time, we should expect that their stock price also grows over time. So if we have a business like Apple and it triples its earnings over the next decade, we should see roughly a triple in its stock price as well. Now, the other factor that heavily influences asset prices in general, and the stock market is no exception, is interest rates. Now, interest rates are basically used as a reference point to value cash-producing assets. So let's say that you have Apple, and I'm just making these numbers up off the top of my head, but let's say Apple earns $1,000 per year in cash flow. Now, if you want to earn about a 10% return from that, you're probably willing to pay around $10,000 for the entire business of Apple. And that is a very simplified way of thinking about valuation, but that's kind of the way people think, at least generally, about buying into stocks, buying into businesses. They look at the underlying cash flow just like you would for a rental property, and then you can kind of figure out an attractive price to pay for that. Now, let's take this scenario where interest rates got much higher than they are today, and you can earn 10% returns per year by just putting your money into a bank account. Now, when you put your money into the bank, there's basically no risk, and you kind of collect your 10% per year. So what kind of flow-on effect does that have to this valuation of Apple? Now, Apple is still sort of chugging away, producing its $1,000 a year in cash flow, but people are not going to be willing to pay $10,000 for Apple and get their 10% return. They might only be willing to pay, say, $5,000, and they want to get a 20% return. They're earning $1,000 on the $5,000 investment. So anytime that you have a decrease in interest rates, you tend to see the stock market go up. And anytime that you see an increase in interest rates, you tend to see stocks more generally go down. That's how the stock market works in general. And we know that over a long period of time, although there's many fluctuations in the middle, stocks tend to follow the earnings of the underlying company. Now, how do value investors take advantage of that? Well, basically, value investors are looking for this gap between the price of the business and the underlying value of the business. And hopefully we're able to buy businesses for a price that is far below their actual intrinsic value. And what we basically bank on is this gap between price and value eventually closing over time. So if we think a business is worth $100 and we can buy it for 50, we basically get our return in one of two ways. So the first way is that gap between 50 and 100 closes over a period of time, and if that happens in say 5 years, we get a double in 5 years, and that's about a 15% return per year. And in the meantime, we're collecting cash flow on that business. So hopefully that business is actually becoming more valuable than the 100 we think it's worth over that 5-year period. Perhaps we're also collecting dividends, or the company's doing some buybacks in order to create additional shareholder value. And that's kind of the way that we make a living as value investors. So in order for value investing to work, we need this price and value gap to be closing all the time after we've found those opportunities. So that brings me to my next point, which is going through a paper from AQR. Now, AQR is an investment firm operated by Cliff Asness, who is a famous investor and billionaire, in fact. And basically, they came out with this paper called "Is Systematic Value Investing Dead?" And I've already covered actually part of this on the channel, so I'll leave a link down in the description to that video. But one of the parts I didn't cover, and the bit I want to talk about today, is this part towards the end of that paper called "Do Fundamentals Still Matter?" And basically what they were looking at is they were examining this difference in the gap closing between price and value, and how successful investors who really focus on business fundamentals have been over a long period of time. So basically what they did is they ran this sort of cheat code kind of test, this hypothetical not possible way of investing, which was basically, let's say you were in the year 2018, you could basically get in a time machine and go forward to 2019 and see what the analysts' expectations were for earnings for that year. So if you already basically knew the earnings for next year, you then went back to 2018 and invested based upon that, so you could buy into all the companies that were going to earn a lot more money than people expected, and sell out of all the companies that were going to earn less money than people expected, and you could get in on all these earnings beats and so on. They basically tested how good would your returns have been. And unsurprisingly, the strategy has worked extremely well. Obviously, if you could get in a time machine and see what next year's earnings were and you could invest based upon that, you'd probably do pretty well. And this study came out with extremely high Sharpe ratios. Now, a Sharpe ratio is basically just a measure of kind of risk-adjusted return. You don't have to be a statistician or a hardcore quantitative investor or anything to understand that. You basically just need to know that the higher the number in terms of the Sharpe ratio, the better risk-adjusted returns that particular strategy had in that given year. And basically what they found is this strategy came out with very high Sharpe ratios. But interestingly, there were years that knowing the earnings of the company actually didn't help you. It was actually negatively correlated with returns. And that has basically happened twice through the period of this study. So the first period was the dot-com bubble, and then for the following years after that, sort of 2000, 2001, 2003, 2004, and so on, this was sort of like the golden age of value investing. This is where a lot of investors that are well known today really made their incredibly high returns. Guys like Mohnish Pabrai, people like David Einhorn, many of these investors really became very, very well known through the early 2000s. And you'll see the Sharpe ratios through that period of time were some of the highest they've ever been. The business fundamentals drove a huge amount of the return that was seen through those early years of the 2000s. And even beyond that point, it has worked reasonably well until we get to the last couple of years. Until we get to 2018 and 2019, those Sharpe ratios get shriveled down quite a lot. And we basically see that we're seeing a lot of the same things that we were starting to see in the dot-com bubble, where fundamentals were not driving returns. Rather, returns were being driven by just multiple expansion, by the business going along steadily and the PE ratio going up through the roof, or the business going along steadily and the PE ratio going down a lot. We were having basically fundamentals not be a key driver for returns, which is kind of scary. So let's look at a couple of example companies. Now, one I really like to use often is Berkshire Hathaway. Berkshire Hathaway being the company of Warren Buffett. Basically, Berkshire Hathaway hit a multi-year low in its stock price right through the dot-com bubble, and it basically hit that low on the exact same day that the NASDAQ peaked, that all the tech stocks in this dot-com boom, dot-com bubble, in fact, were maxing out, got to the highest stock prices many of them ever got to. And what this tells us is basically we had one group of stocks that were extremely overvalued and extremely expensive, and we had this other group of stock with actually really high quality businesses like Berkshire Hathaway in it, basically getting super cheap. And if you had bought a basket of those really cheap stocks, you would have done very well over the following years. And I think there's a lot of good arguments to be had that we might be in a similar situation right now. If you read the full AQR paper, they basically went through and saw that the spread between the most expensive and the cheapest stocks is about as wide as it's ever been. Again, kind of comparable to the dot-com bubble. So there's potentially some really interesting opportunities out there. And just to look at a business as an example on kind of the other end of the spectrum, let's take good old Apple. I like to use Apple as an example in just about everything in these videos for some reason. But Apple has been a business that has had a really phenomenal last decade. It's grown an incredible amount. But over the last couple of years, their earnings and cash flows, their growth has slowed down. They're still growing, probably in around 10% per year. They've done a lot of share buybacks and things which have increased their metrics on a per share basis. But the business growth has slowed. But what we've seen is that people are paying about as much per dollar of earnings for dollar of free cash flow for Apple as they almost ever have. If you look at a metric like the price to free cash flow of Apple and track that over a period of time, you'll see that people are paying a huge amount for every dollar of free cash flow coming out of Apple. And that's the kind of thing you'd expect to see on a business where the prospects are getting better than ever and they're kind of on this, massive growth trajectory. Whereas Apple is at the tail end of their growth and they're really starting to kind of level off. So there's some really interesting stuff going on in the stock market at the moment. There are a lot of really good arguments that, there's a lot of cheap stocks out there and a lot of expensive stocks out there, and there's not a whole lot in the middle. There's kind of this wide range of valuation going on at the moment. And my final point for you to take away would be to look at how your own portfolio has performed over the last couple of years and try to understand what's driving that. Has it been business growth or business decline? Has the actual company underlying that stock done really well or really poorly? And has that driven your returns? Or has the business basically been steady and, your returns have just been driven by people willing to pay more for every dollar of earnings? So those are a few things worth examining. I think it's frankly probably a pretty good time to be a value investor, even though it hasn't been over the last 5 or 10 years, particularly if you're this quantitative style value investor. It's been okay if you've been a Buffett, discounted cash flow kind of person up until the last year or two. So that's a bit from me. I do hope you enjoyed the video. If you did, please hit like and hit subscribe, and I will see you in the next one. Cheers. Mo check.